Fun fact, the most expensive stock in the world is Warren Buffett's Berkshire Hathaway. It is worth $320,250 per share and has never devalued the worth of a single one. Wowza! As much as every single one of us wishes we could be as good as Warren Buffett at investing, there's actually so much to learn before that could potentially happen. This is Investor Info, and in today's video, we will be looking at how to choose a stock if you're a beginner at investing. Let's get started. So you've made the decision to begin investing. You probably already know that a low PE ratio is preferable to a high PE ratio, that a firm with a large cash balance sheet is preferable to one with debt, and those analyst recommendations should be taken with a grain of salt. You're also aware of the clever investor's cardinal rule. A portfolio should be spread across several sectors. Whether you've plowed through the more advanced principles of technical analysis or not, that pretty much covers the basics. You're all set to choose stocks. But hold on, how can you pick a few stocks worth investing in when there are tens of thousands to choose from? Whatever some experts claim, combing through every income statement to find companies with a good net debt position and growing net margins is simply not doable. Stock pickers that are successful have three things in common. Number one, they've decided ahead of the time what they want their portfolios to accomplish and are committed to sticking to it. Number two, they are up to date with the daily news reports, patterns, and events that affect the economy and the businesses that operate inside it. Number three, they use their goals and information to guide their stock buying and selling decisions. The first step in investing is to figure out what your portfolio goal is. Everyone wants to make money when they invest, but some investors are more concerned with producing a revenue supplement during retirement, safeguarding their wealth, or capital appreciation. There are three types of investors. First up are the investors who are looking for a steady stream of income. Also deemed as dividend investors, they focus on purchasing and holding investments in corporations that pay out regular dividends. Their overall portfolios are usually stable but slow-growing enterprises in industries. These include utilities, highly rated bonds, real estate investment trusts, REITs, and master limited partnerships, among other similarly low-risk options. Next are the investors who seek to preserve their capital or initial investment. They usually have a low risk tolerance and prefer to put their money into well-established blue-chip companies like Coca-Cola and Apple, which have very good company foundations and remarkable past records. Often, they focus on consumer staples, which are companies that have proven time and time again to thrive in both good and bad times. Lastly are the investors seeking capital appreciation. These types of investors don't mind taking risks in return for high returns. They often target equities of firms that are still in their early stages of growth. They are prepared to face a higher level of risk in exchange for the possibility of large rewards. Just think about how Amazon was just under $2 when it listed in 1997, and how it has gone up to more than $3,000 in a span of 2 decades. If you were to invest just $2,000 in 1997, your investment would be a whopping $3 million today. Crazy, right? Any of these investment categories could use a mixture of the tactics mentioned above. That is, in fact, one of the primary motivations for diversification. Growth stocks might make up a tiny part of a cautious investor's portfolio. To offset any losses, a more aggressive investor might set aside a percentage of their portfolio for reliable blue-chip stocks. The easy step is figuring out which category you belong in. Choosing which stocks to invest in can be difficult. Keeping up with market news and information is critical. Passive research includes reading economic news and following up with industry blogs written by writers whose perspectives you find interesting. An investing thesis can be built on the foundation of a news item or a blog post. A common sense observation can also serve as the fundamental argument. You might notice, for instance, that developing market countries are generating new middle classes made up of people who want a wider range of consumer products. As a result, demands for particular items and commodities will increase. Identifying firms is the next step in the stock picking process. There are 3 easy ways to go about it. Number 1. Look for exchange-traded funds, ETFs, that follow the growth of the company you're interested in and investigate the stocks they hold. It's as simple as looking up Industry X ETF. The fund's top holdings will be revealed on the official ETF page. Number 2. Use a screening tool to narrow down stocks based on parameters like sector and industry. Screeners give customers more options, such as sorting firms by market capitalization, payout ratio, and other important investment criteria. Number 3. Look for news and opinions on firms in the investment space you've chosen in the blogosphere, stock analysis papers, and financial press releases. Always remember to be cautious of what you read and to consider both sides of an argument. There are distinct advantages and disadvantages to each method that investors should evaluate. Finding expert viewpoints through news sources takes time, but it can be fruitful. It will help you have a better knowledge of the principles of the industry. It may also alert you to intriguing smaller companies that aren't found in screeners or ETF holdings. Once you've determined that the industry you're interested in is a sound investment and you've familiarized yourself with the top players, it's time to focus on investor presentations. They are less thorough than income statements, but they do provide a general summary of how businesses make money and are easier to comprehend than 10Q and 10K reports. These reports will also include information on the company's and industry's predicted future directions. You can narrow down your search by looking at the company's websites and presentations. The method is a more in-depth examination of a given company to determine whether it can surpass its industry competitors. You may end up with a single investment possibility or a list of 10 or more businesses at the end of your investigation. Alternatively, you may determine that this is not the industry for you. That's alright. All of your research could have saved you from making a poor decision. When it comes to stock choosing, recognizing when to say no is crucial. You may be ready to pull the trigger, or you could do an in-depth financial statement examination like a financial industry pro. Things to keep in mind. Not every investor wants to achieve the same results with their money. Young investors are likely to be more concerned with building up their portfolio as much as possible over time. As they approach retirement age and aim to live off of their assets, older investors are more likely to be more concerned with capital preservation. And some investors like to receive regular income in the form of profits and distributions from their investments. Take a moment to consider what you want to achieve with your financial portfolio. There are no guidelines to follow. You can be in your 60s and want to build your portfolio, or you might be in your 30s and want the security of some additional investment income. Be advised that you become a partial owner of the company when you acquire a stock. You're asking for trouble if you don't grasp the business. Would you allow yourself to take complete control of a company whose operations you're unfamiliar with? How are you expected to determine if your management is doing a good job, even if you hire competent people? Companies can be found almost anywhere. Take the time to think about the companies behind the items and services you use every day. Evaluate companies that may have an indirect impact on you. Consumers are rarely dealt with directly by many businesses. Who makes the machines that accept your money when you go to the store to check out? Who makes your medicine when you buy it at the pharmacy? What kind of gear do they have? Where do mechanics acquire new components when they fix your car? And who makes those spare parts? Who is truly responsible for developing new towers and making the gear that goes on those towers when your phone connection drops because there isn't a cell tower in sight? It's time to start cutting down the list now that you've considered a large number of organizations and their competitors. A permanent competitive advantage, or a moat, is the most crucial thing to look for in a firm, according to Warren Buffett. A moat can be made from a variety of materials. Understanding how scale, switching costs, unique brands, intellectual property, and the network effect may provide a company a competitive advantage that will help you spot them in the companies you're looking into. Invest in companies that are trading at a discount to your estimate. This is your safety margin. In other words, if your evaluation is off, you'll save a lot of money by buying considerably below market value. Warren Buffett's success as an investor is also due to this factor. You might not need a large margin of safety for a stock with stable profits and a positive outlook. You'll probably be alright if you take 10% off your desired price. You may desire a larger margin of safety for growth stocks with less predictable earnings. Aim for 15 to 30%, depending on your level of confidence in your estimation. Because you purchase shares at a relative value, you'll be covered if things don't go as planned. For example, if the young firm meets a new issue or a larger company decides to join the market. There's no need to buy a stock at the very lowest price. Assure yourself that you have done the required research to make an informed decision, and when a good deal appears, take it. And there you have it, folks. Now that we have discussed how to choose a stock for investing beginners, let us know your thoughts down in the comment section below. Do you think you could master the art of investing? Or do you think it is rocket science? Nevertheless, remember to always do your research and make the most out of your resources. If you found this video helpful, feel free to leave a like and subscribe to our channel for more videos just like this one. See you in the next video.